Según Canavan, lead US analyst in Oxford Economics. Hi, good morning.
Good morning. Thank you for having me.
What do you think about the macro analysis that this week with CPI, the inflation and unemployment? What do you expect of this?
So we expect that the figures will be broadly supportive for U.S. markets. We think that the employment release, the delayed employment release on Wednesday, will show about a 30,000 increase in employment. That's less than the market expects. The market's looking for around 70,000, but that slight weakness shouldn't be a significant problem because it should reinforce expectations for Federal Reserve rate cuts later this year. So we think that will actually be potentially a small plus. It's sort of just strong enough to keep market participants from being overly worried about the economy and just weak enough to keep market participants betting on Fed rate cuts. CPI, we're pretty much in line with expectations. I think the broader CPI story isn't such a big question about the latest release this week, but the longer term outlook. And on that front, we are pretty positive. We do think that over the course of this year, as the impact of tariffs continues to work its way through the economy, and as increased productivity continues to support labor, unit labor costs, we do think that inflation will gradually decline over the course of this year and into next year, getting close to the Fed's 2% target. So we think that the combination of CPI and employment data should be a small net positive for markets overall this week.
What do you think about the past week of the losses past week with gold, Bitcoin, and the software companies?
Yeah, so we're not overly worried about that. So Bitcoin is sort of its own animal. Its correlations to different asset classes comes and goes. It's really more of a momentum play. It had gotten to extreme valuations once it began to sell. It was clear that a lot of Bitcoin investors simply got stopped out of positions and forced to sell, and just created a cascading wave of forced selling. Gold was similar. Gold has been on an exponential rise, over the last more than a year. And it had really just sort of gotten a little too far, a little too fast, and it was ripe for significant profit taking that we saw. But we've seen both stabilize over the last few sessions. I don't think that what we saw last week is a signal of necessarily a further consistent deterioration in the assets, but more just a retrenchment towards more reasonable potential values, particularly for gold. As far as the software, as far as equities are concerned overall, the AI questions are liable to continue to attract some volatility in equities over the near term. Over the long term, though, we are still quite positive. Over not the long term, just the medium term, even over the course of this year. We're still quite positive on equities. So I mentioned before that we see inflation continuing to decline over the course of this year. That's a positive. That decline in inflation will allow the Fed to cut rates further. We look for 2 more rate cuts this year, one in June, one in September. That'll be a positive for equities. We also see strong economic growth this year, economic growth 2.5% or above overall this year, as the One Big Beautiful Bill Act generates larger tax refunds, puts more money in people's pockets in April and through the April tax season, and also allows CapEx spending to increase for companies as they're able to write off those CapEx investments more quickly. So we think these factors will be supportive for equities overall over the course of this year, even if the volatility is a little higher over the near term, given some of the AI questions.
What do you think about Kevin Warsh and the independence, the Federal Reserve?
Yeah, so Kevin Warsh, I think there's just a lot of questions that we'll get some more answers to in his nomination hearings. But I do think as far as the Fed independence is concerned, that he is going to be a net plus for the Fed. We do think that President Trump respects him, and he's, President Trump will attack anyone who isn't doing what he wants them to do, but at the same time, he will be the person he installs and someone who he clearly favors. We think that will tend to hold back President Trump's attacks on the Fed. We think that'll be a net plus. And Warsh himself is, he wants a lot of changes at the Fed, but he's still an institutionalist as far as Fed independence is concerned. He's been on the board of governors in the past. He believes in the Federal Reserve overall, even if he would like to see some significant changes at the Fed. And I think that combination could potentially relieve some of the pressures that the administration has put on the Fed and some of the risks to Fed independence that we've seen over the past year. So it should be a net plus from that regard.
We are living a market opportunity, or this is advice about an alert about the possible bubble in the artificial intelligence.
Yeah, I think that we still have a very good opportunity, right? So I think for equities, the things that I described, the things that I mentioned will be very positive for equities. While there are some risks of a bubble in aspects of AI and AI investment, the question is who will come out of that as winners, and so we can't see that yet. So while some AI companies and AI-based companies might be in a little bit of a bubble, there's no way to know which companies those will be, which companies will survive, and which companies won't over the next few years until we see. So I do think that from that perspective, that elevated valuations for tech companies will remain, even if, as we discussed, they might be a little bit choppier over the near term. For the Treasury market, the U.S. Treasury market, there's still some value there. As I mentioned, we expect inflation to continue to decline over the course of this year, allowing the Fed to lower interest rates. That combination should be good for treasuries. There are obvious supply risks given the size of U.S. deficit, but we think those are more longer-term risks than near-term risks. And so in the near term, over the course of this year, we think that markets overall are really probably in a pretty good and supportive position to continue the strength that we saw last year. Albeit equities, obviously, the prior 2 years have, equity gains have been through the roof, and we do expect we'll see a slowdown from the extent of the equity gains that we've seen, but we do think that markets will continue to rise, just albeit at a slightly slower pace over the course of this year.
Thank you very much for having this time with us. Según Canavan, lead U.S. analyst at Oxford Economics. Good day, good business.
Thank you very much for having me.